Kristen King from the Investing Channel, and welcome to IP Go, the show where we take a look at the IPO world, past, present, and future. Last week, we highlighted the impending listing of mobile apps and gaming business AppLovin Corporation and questioned whether its very lopsided voting structure would be an issue for the business as a listed company. The deal was priced at the midpoint of its indicated $75 to $85 range, and the company raised $2 billion as a result. However, there was little love for the company among investors on debut, with the stock trading down as much as 17% below the issue price on day one and to as low as $56.53 subsequently. Retail traders are becoming more discerning, and the attractions of a business that lost $126 million on turnover of $1.45 billion in 2020, where the founders and major shareholders control more than 90% of votes, are limited, it seems. The envelope may have been pushed too far in this instance. Interest from Asian businesses in U.S. listings continues to grow, and the latest company to consider crossing the Pacific is South Korea's Naver, which offers search, e-commerce, and fintech services in the country. Naver recently raised money through the sale of $500 million of U.S.-denominated green bonds, and it is considering selling more to fund environmentally friendly data centers. The company has also been expanding outside of its domestic market, which currently accounts for 95% of revenues. Naver has taken stakes in Spanish online marketplace Wallop and Canadian social writing platform Wattpad. Naver is cash-rich, has 65% of the Korean language search market, and is unlikely to list its whole business stateside, but it could well test the water, with a listing for one of its divisions having seen how well IPO of local rival Coupang went earlier this year. We will update you as and when we learn more. Back at home, entertainment group Endeavor, founded by Hollywood big shot Ari Emanuel, is hoping to IPO with a valuation of $10 billion, despite the pandemic reducing the company's revenues by as much as 25% over the last year. Endeavor would look to raise as much as $1.8 billion through an IPO and a further $1.3 billion through a private placement of shares to UAE-based Mubadala Investments and New England Patriots owner Robert Kraft and others, including Michael Dell, Elliott Management, and Silver Lake. If the deal is successful, and with backers like that, why wouldn't it be, Endeavor will use the money raised to purchase the 49.9% shareholding in the Ultimate Fighting Championship that it doesn't already own. In fact, we could say that the big hitters are coming to Wall Street in more ways than one on this occasion. Endeavor had previously aimed to list in 2019, but had to abandon its plans because of lack of investor interest. That doesn't seem to be an issue this time around, though the way the deal is structured will appeal more to its prospective billionaire and venture capitalist shareholders than to retail traders. Morgan Stanley, Goldman Sachs, and JP Morgan are coordinating the IPO, which has an indicative range of $23 to $24, which would trade under the ticker EDR. In many ways, Endeavor Entertainment would have been well suited to listing through a SPAC, or Special Purpose Acquisition Company. However, there are signs that some of the gloss is being knocked off of this market. The sheer weight of numbers of SPACs coming to the market and then competing for deals has created an oversupply. Yes, some deals are still making the headlines, such as Singaporean ride-hailing app Grab's proposed $40 billion merger with Altimeter Growth Corporation. Yet recent research has shown that there are as many as 435 SPACs looking for a deal right now, and that just over 300 SPACs are trading below their common $10 issue price. That means many of them are trading at a discount to the cash raised at IPO, which they now hold in trust. That suggests investors may have fallen out of love with many of these names. What will be most important going forward is deal flow and just how quickly and how many of these vehicles can find a viable takeover target. SPACs have a shelf life of just 24 months in which to find a deal, or if they can't, they must wind up and return cash to shareholders, and that clock is ticking. That's all we have time for this week, but as usual, make sure you do your due diligence before making any investment decisions. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar.